Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday, the 31st of October 2013. Let's look at this market. We're looking at the screenshot of the close as of October 15th. That's when the S&P 500 made its year-to-date low, or I'm sorry, the low of that pullback. And we saw the S&P was down 5.5% for the month. The Russell 2000 was down 7.5% for the year. Looking at that same chart with today's numbers, what we see is that the S&P 500 is up 2.3% and the Russell 2000 is now up 1%. So just in 16 days, we've seen that kind of change here in this market. Really an incredible turnaround. Definitely bigger than anything I expected. I thought that there were a lot of damaged stocks, but we had also tried not to pick the bottom, but to participate as the market started rallying. So let's take a look here at the S&P 500. You can see we are at a closing high, I believe. Let's just take a look at that together. Today's high of close of 201.66 did beat, I'm sorry, that close was 201.82. So just a few pennies off of the closing high here. It's been a spectacular couple weeks off the lows. And again, let's just take a look at the 30-minute time frame. Here we see we were not trying to pick the bottom as it made lower highs and lower lows below a declining 5-day moving average. But the first time this market told us that we had first a higher low at above a flat to rising 5-day moving average, and then the higher high confirmed it right here. That's when we became more willing to participate in the upside. We had confirmation that the intermediate term trend was rallying, and in that time we've remained steadfastly bullish, saying we're above a rising 5-day moving average, we're making higher highs and higher lows, there's no reason to be short here. If you don't agree with what the market's doing, then sit on the sidelines and cash rather than try to fight it. A lot of people looked at, and I did as well, potential levels of resistance. We had seen, Fibonacci numbers get completely blown out. We saw moving averages such as the 50-day moving average get blown out as potential resistance. That's why you don't short at those levels. These are just things, tools that is, that tell us now's the time to be taking a closer look at the shorter term time frames to look for evidence of a possible turn. However, when we look at the, even over here at 196.75, when we look at that, there was zero evidence. 196.75. There was no reason to be short over here as the market was breaking to new highs, and we were above a rising 5-day moving average. So once again, I'm going to repeat it over and over again. You've heard me say it for 10 years or so. Trade in the direction of the 5-day moving average for your intermediate term trends. If the market is above a flat to rising 5-day moving average coming off of lows, then it is innocent till proven guilty, and you manage risk. You don't try to pick tops. You manage risk and say, okay, listen, I'm not going to be the guy who buys into this weakness, and I'm not going to be the guy who sells short because I think it's up too much. That's how you lose money. Picking the bottom is a very difficult task. If you did it, congratulations. But again, there's still plenty of upside opportunity that's left in these markets after they make those flush out lows like we saw here. So for the week, 2.6% in the S&P 500, NASDAQ close to 3%, close to 5% for the Russell 2000. And look at gold, down 5% on the week, down 3% year to date. That actually makes me happy because it's been in a primary downtrend and there's been no reason to buy it. The NASDAQ, as we know, up at a new high here, breaking past that $100 level with ease today on that gap higher. And some people thought the market was up too much. They were shorting it. And as I've been telling subscribers every day, we're innocent till proven guilty. Yes, we're extended, but being extended doesn't mean that we start to look for places to short. It means that we reduce share size. We become more cautious. We raise our stops and be ready for the signal that if the market gives the signal that it's reversing back lower, then we're ready for that to exit our positions, and perhaps if you're more flexible to go short. The Russell 2000, as we know, was the first market to break an important level of resistance, and that was at 107. As that occurred, that we had the higher high with over here the higher low, and it was really confirmed right here that the buyers had regained control, and that's nowhere near the bottom. And that, you're never going to try to see me trying to pick the bottom. Instead, to say what's the intermediate term trend. We have a rising 5-day moving average. It's innocent till proven guilty. A little shakeout is just a little shakeout until we see the 5-day moving average flatten out and turn lower, and then we have lower highs and lower lows below it. then maybe we would have sold off further in the Russell 2000 at that prior potential resistance level. So when we look at the weekly time frame here, what we were talking about is the fact that this market had given us a clear signal that the sellers were in control. It broke to a low. It broke below the low of this big support level, and it had. So what we had was a lower low and a lower high. Now we're getting back up in this market on the longer term weekly time frame. We've blown those shorts out of this market, I think, with this incredible rally here. So we're back to a more favorable market environment. Of course, we are extended here, and if we were to see a pullback in the next couple weeks, even down to 112, I think even if you saw a pullback to 112, we could see an inverted head and shoulders pattern set up here. But right now, again, the focus needs to remain on risk management. Which stop, where are you most comfortable putting your stop? Is it under today's lows? Maybe it was Thursday afternoon low, I think would be a more reasonable place down near about 114. That's where we'll see this rising 5-day moving average kind of catch up to the market as well. Semiconductors had a shakeout this week. We did not see, however, what we didn't see, that is more important than what did happen here. What we did not see was a pattern of lower highs and lower lows below a flat to declining 5-day moving average. The 5-day moving average started going sideways here, and I told subscribers if we break back below there, then at that point we would have a lower low with this lower high, and it would be okay to short here with a stop up there. So it put us cautious, but because the 5-day moving average was still advancing, we still looked at it as innocent till proven guilty, kind of a yellow light, had the potential to go red, but instead it turned back to green through some trick. Anyways, there's no point in being short these markets, not with a rising 5-day moving average. The financials, you might say they're up too much. They've just rallied 10% or more here in the last 3 weeks, right up to the highs for the year. In fact, that's a new closing high for the financials. And, you know, the pattern is still higher highs and higher lows. We've got a rising 5-day moving average. So, 2350 will be an important level for this market to hold next week. If we drop down towards that, start to maybe turn sideways a little bit, then we could see further pullback, but the evidence is not there that sellers are taking any control of this market. Where the sellers are is where they should be, in the garbage that's in a downtrend, such as gold. Gold has been, as we know, as I've been saying, if they don't scare you out, they'll wear you out. Best case scenario for the longer term was that we were turning sideways, but we've been talking more about the more frequent tests of support and the fact that this prior support level held as resistance, that it seemed likely that the market would in fact break down to new lows in gold, and it did so today with its nice drop here. So we saw the rally up to the declining 50-day moving average, and then the place to short it is as it makes lower highs and lower lows below a declining 5-day moving average, and the short side is the correct way to go. We're right now even at a trend line that goes back 10 years, 9 years, I guess. And we've broken that. We have the lower highs coming into it. So I wouldn't be surprised to see gold continue lower from here. What we'll be looking for over the next couple weeks is that this is basically, I think that, if you look at about 114.5 to 116.5, this prior band of support has the potential to become resistance. So we look at this very similar to the way that we looked at the Russell 2000 and this prior band of support. Now, the best thing that could happen to gold, if you're bullish, is that we're seeing that gold is right here at this point. And let's go back to gold for one moment. So let's go here. So we've broken below this big support level. Now if it rallies up, it has the potential to become resistance. It will need to get back above 117 or so for me to say, hey, that was a shakeout, the way that we can now say back above 110, 111 was confirmation that that was just a shakeout. Right now, though, there's no evidence that this is a shakeout. We have lower highs and lower lows on all of these time frames, so there's simply no reason to be involved in gold. The gold is doing what a downtrending market is supposed to do. It's supposed to make lower highs and lower lows. It's got nothing to do with your opinion of what you think gold should do or anything like that. The dollar, obviously, inverse of that is right up up against the highs from 2012. Bonds started to stabilize a little bit this week. That is, we've been talking about after this rally and kind of that blow off top over there near 125 here on the daily time frame. We said, over here, lower highs and lower lows below declining 5-day moving average means that it's time to become much more defensive. It gapped up above the 5-day moving average, and then it had the chance to make a higher low and then perhaps go back to the higher high. Instead, it's more neutral here on the intermediate term. Next week, I think if we can get back above this peak right here, then perhaps we'll be able to see the bonds continue to move higher a little bit. But for right now, they're looking more neutral with perhaps more stabilization coming at least. Alibaba has been a great trade. I spoke pretty aggressively about this one on Yahoo Finance and on chat. I posted charts about how breaking past the volume weighted average price year to date was where you wanted to buy this stock, as it made a higher high right here. And I said it looked like it was headed for new highs and up towards 100. That's been obtained. If you're long Alibaba, I would say that your worst case stop at this point probably goes at about 96.60, because we see that 5-day moving average is flattening out. And if we get down, rally up, and then break below that, then it will tell me that we need to see the stock pull back once again. And it's been, meanwhile, it's been a great trade as it made that higher high above the volume weighted average price year to date. Some other stocks to look at. Let's look at actually the XLE, which is the energy sector. The energy sector has been one of the most beat up, and I spoke about that on Yahoo Finance as well a couple weeks ago, saying that I thought it has the potential to be able to continue to bounce because it was into this prior level and this big trend line that we had seen off of the 2009 lows. So the financials, not financials, but the energy stocks, they are trying to recover. Now it's badly damaged. Perhaps we see them continue up towards that declining 50-day moving average, but the declining 50-day moving average tells me that it's not likely to be able to continue. But for the intermediate term, we have what? Well, today we saw a higher high with a higher low above a flat to rising 5-day moving average. So if you're long the XLE, then at this point, I think the safest stop goes just below that 5-day moving average near today's lows. The silver was actually even a bigger break here the last couple days. It broke down hard on Thursday and followed through on it today. Volatility continues to diminish in here as well, the VXX. Apple was up another $1 today, so as I'd said to subscribers, I thought maybe below here was where they could put their stop, and but to do what felt right for them. The fact is, we still have a rising 5-day moving average, and this market remains above it. So there's certainly no reason to sell short Apple. And then Amazon is clawing back from its gap down a week ago, but it's still in a primary downtrend with a declining 10, 20, and 50-day moving average. So I wouldn't have a lot of high hopes for Amazon, especially in the light of the fact that we have this prior support which has the potential to become resistance. Twitter broke down a little bit this week. We had gone bullish on Twitter back over here as it got above the it was back here as it made that first higher high above the flat to rising volume weighted average price year to date. Now we're back below that one again. So it looks like Twitter is going to kind of need a lot more time to heal. I wouldn't suggest anyone try to buy it in here right now. And Facebook needs some time to settle down as well. It had a real nice recovery off those lows, but then earnings came out, and now it's back to this prior support, holding as resistance. I think that Facebook is likely to see some further selling, perhaps even down towards the low 70s level. GoPro had a nice day, but it's still kind of a damaged chart in there a little bit. Either way, there's a lot of opportunity in this market still, and it's not all gaps like we saw in LinkedIn. There are still some good tradable setups, and that's what I talk about each and every day in Alpha Trends. So if you haven't taken a trial, feel free to go ahead and do so. And now's the time actually that there's a 15% off any subscription that's at least a quarter long. So 3 months or the annual subscriptions are 15% off through Sunday only. So take advantage. There's a coupon code on the website.